What does the rising price of gold mean? See, it's not good news. Gold hitting 15,000 an ounce means something is really screwed up in the economy. You see, there's something very, very sick inside the economy and in our monetary system to be driving gold that high. Why is the price of gold rising? What's going on in the economy?
It's a little bit of technical analysis, not overly technical. We're in the third great bull market in gold in history. When I say in history, you're like, well, gee, history's a long time. How come this is only the third bull market? Well, the answer is for almost all of history up until 1971, gold was money. So you didn't have bull markets or bear markets. It was just gold. When Nixon suspended redemption of dollars for gold by our foreign trading partners, that gold just went its own way, detached from the dollar. So the dollar would do what it was going to do, and gold had its own market and still does. The first great bull market was 1971 to 1980, and gold went up over 2,000%. Then there was like a long, drawn out, almost 20-year bear market from 1980 to 1999, and gold dropped down to around 250. So it went from the 800 level down to 250. The second great bull market was from 1999 to 2011. August 2011, gold went from $250 an ounce to $1,900 an ounce. That was an almost 700% gain. Then the second bear market, August 2011 to December 2015. The third bull market, I can give you the exact date, December 16th, 2015. Gold hit $1,050 an ounce. That was the bottom of the second bear market I described, a pretty steep fall from the 1900 level. If the first bull market was up 2,000% and the second bull market was up 700%, if you just take the average of those two, you don't have to pick the higher of the two, you don't have to go crazy or say it'll be bigger than ever. It could be, but you don't have to do that. If you just take the average of those two, you would come up with a number around 1,400% gain from where from the 1050. Well, that would put you at almost $15,000. You got a long way to go to 15,000. So why not get the gold now, which I do recommend. $1,000 gain is $1,000 gain. If you have an ounce of gold and it goes up $1,000 an ounce, you just made $1,000. That's real money. But because you're working off a higher base, each $1,000 gain is a smaller percentage than the one before. So when you move from $2,000 to $3,000 an ounce, that's a 50% gain. But when you move from 14,000 to 15,000, it's only a 7% gain. But again, $1,000 is $1,000. It's the same amount of money, but it's a smaller percentage, which means it's easier to hit. And so the hard work is right now, kind of getting to 3,000, 4,000, which it will. But it can really take off from there. $100 days are going to be the norm. $1,000 weeks are not going to be unusual, and they'll be more and more frequent as we move along. The global money supply is about, I'm using M1 and the major economies, which is about 80% of the global GDP, is about 33 trillion. And there happen to be about 34,000 tons. So you need about 12 or 13 trillion dollars worth of gold to back up that money. Well, if you have 34,000 tons, and you need about $13 trillion of gold to back up the money supply, what does that come to? We'll just divide by one by the other, and again, you get a number close to $14,000 an ounce. So there are two completely independent methods. One is the technical historical look, the other one is a monetary look based on money supply. But interestingly, they come out in the same place.
When you're saying they're not going to be able to make money, what's your prediction on banks? Are we losing the banks? Is their system going to change?
No, the banks are necessary. They may not be everyone's favorite institutions, but they are necessary. The big ones will not be allowed to fail. We know they're too big to fail. So they're almost like utilities, like the electric company or the phone company or something like that. They're not going to fail, but they don't have to be particularly profitable. And that's what Buffett's saying. Is that, yeah, you'll be around. Citibank will be around in 10 years, but may find it extremely difficult to make a lot of money in this environment. So get out of it.
So Jim, would you mind explaining a little bit more differential between bonds and gold?
When interest rates go down, the price of the bonds goes up. And when interest rates go up, the price of the bond goes down. And the reason for that is if you have a bond with a certain coupon and interest rates go up, a new buyer is going to want that new bond. He's going to go, hey, give me that higher coupon. well, I got this other bond over here, it's got a lower coupon. It's like, well, you have to sell that to me at a discount because I need to get comp for the fact that it doesn't have as high an interest rate. So simple as that. Interest rates up, prices down. Interest rate down, prices up. That's how the bond market works. I don't see the Fed going to a negative interest rate. So, negative target on Fed funds rates. However, you can have negative rates in the bond market even if the Fed funds rate is zero. How does that work? It happens through secondary market trading. Bonds can produce a negative yield to maturity through secondary market trading, even if the Fed sticks to zero. So in other words, when you're at low levels of rates, which we are right now, every basis point decline in rates produces a bigger capital gain than if the same thing were happening at higher level of interest rates. So this could be one of the greatest bond market rallies in history, starting from 70 basis points. If you get to negative 1% yield maturity through secondary market trading, those are huge capital gains.
The reason everybody says you don't buy gold is because it had no yield. And is it accurate with you, the more that the price or the yield on bonds or your interest on bonds goes down, doesn't that affect the price of gold?
It's generally correct. So if gold is competing with money market funds, bank CDs, short-term investments, etc., if gold is competing with these money market or substitutes of money market funds, and their rate is zero, and gold's yield is zero, then it's a fair fight. Now it's all about capital gains. Now, obviously, we already talked about in the last segment how you can make 10 times your money in capital gains on price of gold. But if you're comparing yield to yield, even assuming the price is going to be constant, it's a fair fight. If they're both at zero, then take a pick.
The new Great Depression. Are we in a new Great Depression?
We are. Depression means depressed growth. You can have growth in a depression. It's just the growth is below potential. So if your potential is 3.5%, and your actual growth is 1.75%, that gap between, say, 3.5 and 1.75, that gap is depressed growth. Now, if your debt is going up 5, 6, 7, 8% a year, which it is, and if your growth is 1.5, 2% a year, which it is, which it will be in my forecast, then your debt to GDP ratio, when your debt's going up faster than your income, you're going broke. It's as simple as that. We're looking at intergenerational changes. And again, it all comes out of the COVID pandemic. But the pandemic, the social unrest, and the depression, it all converged in 2020.
Are we heading for wheelbarrow money, where it takes a wheelbarrow of money to buy a loaf of bread? Or are we, what else are we going into?
We're in for deflation, not inflation. We may get to inflation. Money supply has nothing to do with inflation. Inflation is caused by velocity, which is the turnover of money. So let's just say you took the money supply from $4 trillion to $7 trillion, which is what the Fed did. In other words, if you don't have velocity, you don't have an economy. The thing that drives inflation is not the money supply, it's the turnover of money. That's the velocity.
So the final question to you is when I buy gold and silver, the velocity stops?
Yeah, because I'll speak for myself, you buy gold, you put it in a vault, and you sit on it. Well, I'm not spending the money.
And that causes deflation.
Correct. And that's why Franklin Delano Roosevelt confiscated the gold
and changed the price of gold
before he raised the price, because it was the ultimate insider trade.